Why did China export 660 tons of silver to London? On November 18, 2025, a shift occurred in the global financial markets that largely went unnoticed by the mainstream financial press, yet it signaled a fundamental restructuring of the global silver market. While the world was watching Bitcoin break records and gold hit new highs, a quiet but violent shift was taking place in the physical silver market that mirrors the exact pattern seen just months before the historic price explosion of 2011. China, the world's second-largest silver consumer, completed its largest quarterly silver inventory dump in 9 years, exporting 660 metric tons of metal from the Shanghai Futures exchange warehouses in a single month. This was not merely a trade. It was a desperate, emergency intervention to save the Western financial system from a liquidity crisis, and it effectively drained China's own strategic reserves to 10-year lows. To understand the magnitude of this event, you have to look past the headline number and understand the policy framework Beijing had established just months earlier. On January 1, 2025, China sent shockwaves through the precious metals sector by placing silver under state trading export controls. The message from Beijing was explicit. They were locking down their silver supply to prioritize domestic industrial needs, specifically for their solar panel industry, which dominates 80% of global production. Analysts at the time predicted shortages, manufacturers panicked, and prices began to climb. Yet by October 2025, just 9 months later, China did the unthinkable. They reversed course and opened the floodgates, sending that massive 660-ton shipment straight to London, the very market they were supposedly cutting off. This was not a strategic policy change or a gradual relaxation of controls. It was a panic move. The London Bullion Market Association, LBMA, the world's largest over-the-counter precious metals market, was experiencing a severe physical squeeze in October 2025. Inventories had become so tight that lease rates, the cost to borrow physical silver, had spiked above 30% annualized. London was screaming for metal, and the premiums being offered made the arbitrage trade irresistible, or more accurately, necessary to prevent a complete market breakdown. China effectively acted as the supplier of last resort, draining its own domestic stockpiles to liquefy the London market and prevent the global pricing mechanism from disintegrating. The cost of this intervention for China was catastrophic for their domestic inventory levels. While that silver was flowing west to London, visible silver inventories on the Shanghai Futures Exchange collapsed from a high of over 3,900 tons in January 2021 to approximately 531 tons by early December 2025. This represents a 75% inventory wipeout in less than 5 years. We are witnessing a liquidation event, not a standard drawdown. The data confirms that China is now effectively scraping the bottom of the barrel to keep the global system functioning, and this inventory collapse occurred at the exact moment their domestic solar industry is consuming more silver than ever before. The most telling aspect of this 660-ton dump is that it failed spectacularly to suppress the price. In a normal market, flooding the system with 21 million ounces of silver should crash the price. Instead, silver prices didn't even slow down. By December 2025, silver had surged to over $69 per ounce, shattering previous records. This counterintuitive reaction, massive supply injection followed by rising prices, reveals the terrifying reality of the current market. The deficit is structural, not cyclical. You cannot fix a geological and industrial deficit with paper trading or emergency stockpile releases. The industrial demand, particularly from solar photovoltaics, electric vehicles, and AI data centers, has become so voracious that even China's emergency liquidation couldn't satisfy it. While China was dumping metal to save the system, the smartest money in the West was quietly taking the other side of the trade. Institutional positioning data reveals a coordinated reversal by the very banks that have historically suppressed precious metals prices. JP. Morgan Chase, the institution that paid nearly $1 billion in fines for manipulating precious metals markets in 2020, flipped their entire book. In January 2024, their COMEX futures desk held 15,000 contracts net short. By November 2025, they were holding 8,500 contracts net long, representing a $6.8 billion swing in exposure. They are no longer betting on the price to fall, they are positioned for an explosion. They are not alone. Bank of America increased its physical silver ETF holdings by 340% in just 2 months during late 2025. This is not exposure through derivatives or paper promises. This is physical-backed positioning through funds like SLV and PSLV, where actual metal must sit in a vault. BNP Paribas followed suit, purchasing 2.8 million ounces of physical silver through their commodity trading division in late 2025, strategically front-running their own public price targets. When the banks move from paper to physical, they are preparing for a scenario where paper promises no longer hold value. They are preparing for delivery failure. This institutional accumulation is occurring against a backdrop of tightening supply chains that goes far beyond the 660-ton export event. While the media focused on the export volume, a critical detail in China's Ministry of Commerce Notice Number 47 went largely ignored. Issued in December 2025, this notice detailed export controls on gallium and germanium, critical metals for semiconductors, but buried in Appendix C was a list of affected refining operations. These are polymetallic refiners that produce 62% of China's byproduct silver. By placing these operations under strict export licensing requirements, Beijing has effectively placed bureaucratic chokepoints on 13% of the world's annual silver supply. These licensing requirements, which demand 45 to 60-day approval windows, create an automatic delay on silver reaching global markets. This means that starting in the first quarter of 2026, the supply valve will be tightened significantly. The Shanghai dump in October was likely a clearing of inventory before these new, stricter control mechanisms kicked in fully. China is moving metal out of transparent, internationally monitored exchanges and into strategic reserves and domestic stockpiles where it cannot be tracked. The trap that is currently being set revolves around a specific timing window between January 15 and February 27, 2026. The Chinese export restrictions become operationally enforceable on January 30, creating a supply shock just as the March 2026 COMEX silver futures contract approaches its delivery window. The open interest on COMEX silver futures recently sat at 163,000 contracts, representing 815 million ounces of paper silver promises. Against this, the registered physical inventory, metal available for immediate delivery, had dropped to just 48.2 million ounces by mid-December 2025. This creates a paper-to-physical ratio of nearly 17-to-1, a level of leverage that exceeds the conditions seen prior to the 2011 price spike. If even a small fraction of contract holders stand for delivery in March 2026, the exchange faces a technical default scenario. The only mechanism to prevent this is for the price to rise high enough to force short sellers to cover their positions and abandon their claim on the physical metal. Analysts projecting the trajectory of this squeeze have identified $89 as the mathematical convergence point for this event. This figure represents the level where institutional profit-taking targets, typically 45–50% ROI from their entry basis of roughly $59, meet the psychological retail FOMO trigger of $90. It is the price point where the banks, having accumulated massive long positions, will likely distribute their holdings to panic-buying retail investors, creating the perfect exit liquidity event. The underlying fundamentals driving this price action are supported by the broader economic outlook for 2026. JP Morgan's global research forecasts a resilient global economy, but one defined by multi-dimensional polarization. The expansion of artificial intelligence is driving a capital expenditure supercycle, fueling demand for electronics and energy infrastructure, both of which are heavy consumers of silver. This industrial demand is colliding with a supply picture that is essentially stagnant. Global mine production has been contracting or flatlining for years. In 2024, global mine production rose only marginally by 0.9% to 819.7 million ounces, while primary silver production actually fell by 2%. This lack of supply response is crucial. Approximately 72% of global silver production comes as a byproduct of lead, zinc, copper, and gold mining. This means silver supply is price inelastic. A rising silver price does not automatically trigger more production because miners are chasing the primary metals, not the silver. Even with silver prices soaring, lead and zinc mines, the largest source of silver, saw flat output in 2024. You cannot simply turn on a tap to produce more silver when 80% of it is dictated by the economics of other metals. The deficit is further exacerbated by the relentless growth of the solar industry. In 2024 alone, the photovoltaic sector consumed nearly 200 million ounces of silver. China added a record 278 gigawatts of solar capacity in 2024, driving this demand. While there is talk of thrifting, reducing the amount of silver per panel, the sheer volume of new installations is outpacing these efficiency gains. The transition to new solar technologies like TOPCon and HJT cells actually requires more silver per unit than older technologies, creating a floor under industrial demand that is much higher than many analysts realize. Furthermore, the geopolitical landscape has turned silver into a strategic asset. The U.S. Geological Survey added silver to its critical minerals list, acknowledging its irreplaceable role in high-tech and defense applications. This designation allows for the potential application of tariffs and trade restrictions under national security frameworks, further complicating global flows. With trade tensions escalating, highlighted by J.P. Morgan's outlook on the impact of tariffs and uneven monetary policy, silver is increasingly becoming a pawn in a larger geoeconomic struggle. The flow of metal tells a story of frantic repositioning. While China exported to London, a massive amount of silver was simultaneously being routed to India. In just September and October 2025, India imported over 2,600 tons of silver. This unprecedented buying spree was driven by India's own industrial boom and a cultural preference for physical assets. Much of the silver that arrived in India originated from the UK and Hong Kong, suggesting that the metal China sent to London was merely a way station before being devoured by Indian demand. This reveals the true nature of the supply chain. Western vaults are being drained to satisfy Eastern demand, leaving the COMEX and LBMA with historically thin buffers. The situation is compounded by the recycling market, which is failing to fill the gap. Global silver recycling rose by 6% in 2024, but this was largely due to price-induced selling of silverware and jewelry in the West. Industrial recycling, particularly from photography, continues its long-term structural decline. There is no hidden stockpile of scrap silver waiting to flood the market and save the day. The easy scrap has already been sold. We must also consider the macroeconomic environment described in the banking outlooks for 2026. Central banks are expected to conclude their easing cycles, with the Federal Reserve cutting rates for. A lower interest rate environment typically weakens the dollar and supports non-yielding assets like precious metals. However, the J.P. Morgan outlook specifically notes a bearish view on the dollar for 2026, which would provide a tailwind for silver prices independent of the supply squeeze. This monetary backdrop creates a perfect storm, where macro drivers align with physical shortages. The risks in this market are profound. The trap mentioned earlier relies on the predictability of institutional behavior. Banks like J.P. Morgan and Bank of America trade for quarterly profit targets, not ideological commitment to sound money. Their accumulation of physical metal is a tactical trade. History shows that during the 2011 squeeze, banks exited their long positions and covered shorts well before the absolute peak, leaving retail investors to hold the bag when the price collapsed. The projected move to $89 is not a permanent plateau. It is a peak from which a violent correction is expected as these institutions liquidate their positions into the buying frenzy they helped create. The timeline for this potential squeeze is tight. With Shanghai inventories at a decade low of roughly 531 tons, China has virtually no ammunition left to suppress prices again. If the London market seizes up again as it did in October 2025, there is no supplier of last resort remaining. The 660-ton dump was a one-time card that has already been played. As we move into 2026, the market will be operating without a safety net. Investors looking at this landscape must recognize the difference between the paper price and the physical reality. The Shanghai Premium, the difference between Chinese and Western silver prices, remained consistently high throughout 2025, trading at a 15% premium or more. This arbitrage window is usually closed by metal flows, but as export controls bite, that window will slam shut, effectively decoupling the physical market in the East from the paper market in the West. This decoupling is the precursor to a price reset. The J.P. Morgan 2026 Outlook also highlights the role of AI and the multidimensional polarization of the economy. This is critical for silver because AI data centers and the associated energy grid upgrades are incredibly silver-intensive. The green economy is not just about solar panels, it is about the electrification of everything. Every EV, every 5G tower, every smart device adds to the cumulative demand for silver. With global industrial demand forecast to remain near record highs of over 680 million ounces, the math simply doesn't work without higher prices to destroy demand or incentivize new, marginal supply. However, bringing new supply online is a slow process. The World Silver Survey notes that while some projects in Mexico and elsewhere are ramping up, they are often offsetting declines from older mines. The reserve replacement ratio for primary silver mines is barely keeping pace with depletion. The industry is not sitting on massive, undeveloped high-grade deposits that can be turned on overnight. It takes years to permit and build a mine, meaning the supply response to $69 silver will lag by half a decade or more. This leaves the market in a precarious position as we enter 2026. The inventory cover in London and New York is at multi-year lows. The Chinese export valve is tightening. The Indian import appetite is insatiable. And the Western banks have positioned themselves on the long side of the trade for the first time in years. The stage is set for a volatility event that could dwarf the moves seen in 1980 and 2011. The trap is not that silver is worthless, the trap is the volatility itself. The trap is buying at $89 because you believe it is going to $150 in a straight line, only to watch it crash back to $62 as the banks take their profits. The trap is failing to recognize that for the institutional players, this is a trade, not a religion. They have identified a mechanical breakage in the market, the COMEX delivery mismatch combined with Chinese export friction, and they are exploiting it for maximum gain. For the individual observer or investor, the signals are flashing red. The drawdown of 660 tons from Shanghai was not a sign of abundance, it was a sign of desperation. It was the last meaningful buffer being spent to keep the gears of the London market turning. Now that buffer is gone, the 531 tons remaining in Shanghai are statistically irrelevant against annual consumption of 19,000 tons in China. The death spiral of inventory depletion has reached its mathematical endpoint. As we watch the price hover around $69 in late December 2025, we are witnessing the calm before the squeeze. The January implementation of strict export licenses in China will likely be the catalyst that exposes the physical shortage to the wider market. When refineries in China stop shipping automatically and start applying for 60-day licenses, the flow of silver that the West takes for granted will stutter. In a market levered 17-1 on paper, a stutter in physical flow is all it takes to trigger a run on the bank. The convergence of these factors, China's policy reversal, the emptiness of Shanghai vaults, the aggressive positioning of Western banks, and the unyielding industrial demand, points toward a violent repricing in the first quarter of 2026. The $89 target is not just a number on a chart. It is the calculated breaking point where the stress in the physical market forces a reconciliation with the paper price. The 660-ton dump was the warning shot. What comes next is the aftermath.